and 72% of the time the market goes up. And the answer came to me. And that's when I developed my chart. The answer came to me is because, just like Caterpillar, when they pull their money out, you get out. Whoa.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, God. Are you nuts?
With your host, Phil Grande.
Bye. Good afternoon and welcome to my podcast. Okay. So yesterday, as we know, the president made a speech but gave himself enough wiggle room that the war is nearly over. But unlike Bush, he was smart and he put in a little wiggle room where he said, yeah, almost. But what's really interesting is tech. The mega tech stocks and AI. They've dropped off their highs between 20 and 30%. And retail investors got totally crushed. Now, you're being told every day now, we're starting to hear it. Go back and buy tech, buy the mega stocks, buy AI. You'll continue to get crushed until certain things happen. But Wall Street's not going to tell you the truth because they're storytellers. So what is it? What will it take to make the AI and mega tech stocks to go back up? And by the way, if you lost around 30%, you're going to have about a 25% or more than that, 43%. You got to have a tech rally go 43% to cover your 30% loss. So that's a big feat. So let's go through, okay, what's needed for a tech rally. Well, first, we need more liquidity. Liquidity. Remember, liquidity is the fuel of the stock market. Not PE ratios, not margins, none of these fundamentals. The market, the price of a stock doesn't go up unless there's liquidity. And we need more liquidity because that's the fuel. Now, the problem is as yields keep rising for the wrong reasons because all of the bondholders are upset. They're saying oil's going up, that's inflationary, I'm taking a big risk holding bonds. So I want to offset that risk with higher yields. So that's a problem. We got yields going up, and we have the economy going down. That's a setup for stagflation. That's got to stop. So, because again, as yields rise and oil rises, the Fed continues to not cut rates. I mean, they won't raise rates. So they need to raise rates to fight that inflation. So we're not going to have a tech rally as long as we're not low on liquidity, as long as we have yields going up for the wrong reason because they're demanding yields. Yields you want to see going up because everything's wonderful, everything's doing terrific, the economy's growing, but that's not why yields are going up. Now, the other thing is that we need the spreads to continue to tighten, not widen. We got to keep the spreads less than 150. Right now they are. It's around 90. If the spreads start getting above 150, you're not going to get a tech rally. So, and yields have to stop spiking during the day, during the trading day, because they got to become stable. When yields are spiking during intraday, then again, you're going to have to get yields to drop back to about 4%. So when you have yields during the day spiking, you're not going to get a tech rally. And yields can't be running, again, as I say, up and down. We need stability. We haven't got that. And inflation has to retreat. We don't have that either. So, and oil prices can't be outpacing GDP growth, and it is. And the spiders and the Qs can't be holding while IWM, the small mid-cap stocks, the heartbeat of our economy, is not holding. Anytime you got that situation where the spiders and the Qs are holding, but IWM is going down, is tanking, that's a perfect setup for ugly stagflation. Nothing worse than stagflation. So these are the things, that's the bucket list, if you will, that you need to get these stocks, the mega stocks, and the AI stocks to rally again. That's quite a feat, because it's not working. The worst thing that's happening, of course, is that we have yields that are going up, and we have inflation going up, which is not supposed to happen. When you have two things like that are not supposed to happen, you're going to go smack right into stagflation. So that's why you're not, so when you hear these jibber jabbers, you hear these financial wizards, these analysts, all talk about you got to get back into tech. The only people that are getting back into tech, like us, who made a lot of money shorting, now we got to go in and buy our stock back. It's called short covering. But institutions, that's what you have to follow. Institutional money. Stop following fundamentals. Institutional money will guide you. You can see where institutional money is going, what stocks they're buying, what stocks they're not buying. You don't get that from PE ratios or from machines. I mean, people just don't get it. They keep on losing. The retail customer keeps losing and losing and losing 70 to 90% because they think the newsletter is their savior. Or the fundamentals are their savior. They're even into machines now. And one minute they tell you the machine, is going to move stocks up. The machine's going to move down. The machines don't even know what they're doing. Here, check this out.
JP Morgan's gone tactically bearish as they see the S&P falling to 6270, a full 10% correction off the peak. These machine sellers are driving the market lower.
So now we have
Stocks rallied on the news that President Trump said the conflict in Iran is almost over. And what this is setting up for is a massive flip in the markets that could squeeze the shorts as the machines are now back in buy mode.
So 1 minute the machines are in sell mode, right after they go back to the buy mode. So I don't care if it's newsletters driven by fundamentals, machines driven by fundamentals. Fundamentals don't work. We got to find out where the money is going, institutional money. And you find that out by following it through the channels that it has to go through. And you need liquidity to get it through these channels. And the more liquidity that we don't have, less liquidity makes it very, very hard for tech stocks to go back up. That's why your gold is going to start doing well. That's right, it's going to start going back up again, your gold. There's only two things that are working right now. One is oil, and not all oil is working. Remember, oil, we've been buying, our gang, we're buying the oil explorers, those companies that explore and find oil, like Exxon and so forth. We're not buying the companies that go in and get it out of the ground, like Halliburton and Schlumberger. Those are turning into shorts. And we have a tremendous amount of shorts on our books right now that we've been shorting, doing terrific with. But that's what's going on right now. So if you're waiting for a tech rally, a boom, and you start hearing Wall Street and the jibber jabber start talking about a boom in tech, if you don't have an increase in liquidity, if you don't have where you have again, where you got the Qs and you got the S&P holding, but IWM can't hold, you're not going to have a rally. You're not going to have a tech rally. So again, remember, there's a lot of red flags we have out there right now. A tremendous amount of red flags that you got to follow, you got to watch. If you don't watch these red flags, you're going to get hurt. For example, as I said, first, let's talk about these red flags. So whenever the spiders and the Qs hold up, but IWM can't hold up, that's where you have a problem. Okay, and it tells you that the breath is terrible. We have terrible breath. And it's telling you too that, again, there's only a handful of mega stocks that are holding up the entire market, just a handful. And it's telling you the foundation of our stock market is cracking. That's what it's telling you. So you got to look at the S&P, the Qs, and IWM. Those three together, keep your eye on that. And as long as we continue to see IWM go down, while the Qs and spiders hold, that's inflation. That could move you right into stagflation. Recession. What's going on with a recession right now? Well, you get a warning for a recession too. And that is yields drop first. That means growth is slowing. IWM drops second, the small mid-cap stocks, the heartbeat of our economy. When that drops second, that's a warning. We're going into recession. Stagflation, again, what's that warning? Well, inflation, again, is rising, growth is tanking. That market is saying, because of that, hey, we're heading for stagflation. So you got to watch the warning signs. Okay, if you don't watch these warning signs and all you do is listen to these jibber jabbers and keep pushing fundamentals, creating a story for you to buy these stocks, you're going to keep losing. Look how much money you lost in these tech stocks instead of shorting. So also remember, for stagflation to occur, two things have to happen at the same time, and they are right now. Two things that should never happen together. Oil's rising, growth is slowing. That's what you really got to be fearful of, is stagflation, because it's so hard to get out of stagflation. It's almost impossible. Think of it, 1972 to 1982, it took us that long to get out of stagflation. Stagflation is a terrible thing, because it's almost impossible to get out, because you have rates that are going up, that's killing your growth, and cutting rates fuels inflation, and every solution for the one problem makes a bigger problem. So you have two problems, and you try to fix one, the other one gets bigger. You fix the other one, that one gets bigger. That's why it took 10 years to get out of. Now there's only going to be four groups in which the market will do terrific. So there is a blessing. So there's only 4 stock groups out of 11. We have 11 sectors, just 4 are going to do terrific. That means, again, that all of the money that is in these 13 institutions, all that liquidity, is going to be pushed through their channels to just these 4 sectors, not 11. Remember, there's 11 sectors. With liquidity, they push that liquidity through these channels, and then every day they're buying and selling. And of course, we can tell what they're buying and selling because they leave a footprint behind, which is price, volume, and momentum. And you can see it right on your chart, how it works. So if you just pay attention to the institutional money, you're going to be fine. But again, there's 4 stock groups that will work. 1, energy. 2nd, miners. Steel is another one, and copper. Now, I'll be more than happy to show you which stocks in those groups. I've been through this. I've been through stagflation. I know how it works. And I can help you. So if you think, if you're real serious about trading, and we're very, very close to stagflation. Of your money, and you are, because you're always looking at the wrong thing, looking at newsletters or machines or looking at fundamentals, or you're looking at the wrong thing. Follow the money. It's been working since the first day Wall Street opened. PhilsGang.com. Thank you for listening.